At this point, you should have done the core case and practice lab and compared your work to the answer key. If so, it's time to review. As mentioned before, a good place to start a return is with last year's return. So what do we have here? We've got $42,000 of wages, and we've got a charitable contribution of $100. We've got something coming from Schedule 1. We'll take a look at that. Taxable income of $23,000, tax of $2,500. Withholding was almost exactly perfect. So the taxpayer ended up over getting a small refund. Notice there's no banking information here, so the refund was by check. If we go to Schedule 1, we see educator expenses. We check the intake booklet, and that also has intake expenses. Educator expenses on it. So that's your tip to ask for the dollar amount. We look at Schedule 3. We have retirement savings contribution credit. There isn't anything specific that's going to tell you as you go through the return about this. So this is a good place to make a note on the bottom of page 3 of the intake booklet that there might be a retirement savings contributions credit again this year, and you need to go and look at Form 8880. And that's pretty much it for the review of last year's return. So next, let's take a look at the intake booklet. I do want to point out that although this has a form number 13614-C, this is page 1 of the intake booklet, that there's a form number that is not the form number for the intake booklet. It's simply referred to as the intake booklet. The first 3 pages are this IRS form, but the other 5 pages are AARP Tax-Aide specific. So we're looking at page 1 of the intake booklet. What's interesting? Well, the taxpayer is divorced, and we have a child, 20-year-old. So that always raises issues about potential custody. Raymond lived with his mother for only 3 months of the year. But when we look over here, full-time student, yes, since he's 20 years old, probably a college student. So college is a temporary absence. So we're actually can put down in text layer that Raymond was present, lived with his mother for all 12 months. Note there are 5 shaded blocks here. They are completed by a certified volunteer preparer. That's you. This will help you figure out the dependency status. This is, again, a requirement. Please don't skip this. So the first question, is Raymond a qualifying child or relative of another person? Well, Sophia's ex is not claiming, the interview notes say, is not claiming Raymond this year as dependent, so the answer is no. Did Raymond provide more than 50% of his own support? There's no indication that Raymond works, so the answer is no. Similarly, the answer is no here for $4,300 or more of income. Did Sophia provide more than 50% of support for Raymond? Yes, she did. There's no indication again of earnings by Raymond. No indication of child support. Did the taxpayer pay more than half the cost of maintaining the home? The home that Sophia rents is paid for entirely by her based on the problem, so the answer to that is yes. On page 2 of the form, we're looking for questions that are answered yes or any that are answered sure. So Sophia has some wages or salary. We saw should have seen that there's a W-2. College or post-secondary expenses, there's a tuition statement. Any of the following, medical, dental, everybody has those. Unless they're extreme, it's not relevant. But charitable contributions, we know the special provision for that in 2021, so we definitely want more information there. Supplies as an eligible educator, we saw that happening in the 2020 tax return. We want to get some more information on that. And receive an economic impact payment. Whether that's answered yes or no, we need to deal with that. Now that you've answered questions about Raymond, you can use that information to determine what tax benefits he brings to the taxpayer, Sophia, his mother. There are 3 different ways to do that. The first is to use the tools that are in Pub 4012 in Tab B. This is the first of them, Determination of Filing Status Decision Tree. A second option is to use the Colorado Tax-Aide tools. Here's the Dependent Qualification Calculator. Rather busy looking, and you may find this useful. We're not recommending it to you, but if you want to check it out, you can do so. The third option, the one that's strongly recommended, is to use the Qualifying Child or Relative Resource tool. This is an 8-page document. It's available in printed form with laminated pages. Can be ordered by the local coordinator. And we're going to be using this to examine what the benefits of Raymond being on Sophia's tax return are. This document is one of the ones that you will find on the web page where the student guides are located. So you can download that and use it yourself. The very first thing that you're asked by TaxSlayer when you go into the return, once you get past the Social Security number, is the filing status. We've been through a case involving married filing jointly. That's pretty obvious. We've been through a case involving a single taxpayer. Again, fairly obvious. But now we have a dependent. And the question is, can Sophia file as head of household, which is a much more advantageous filing status than single? So to determine that, you go to the Qualifying Child, Qualifying Relative tool, and you walk through the charts. So a quick note before we start doing this. A qualifying child does not have to be what we think of as a child. It could be, say, a 40-year-old who's totally and permanently disabled. Similarly, a qualifying relative is a legal term, tax term. A qualifying relative could be a friend who has no income and is staying with the taxpayer, and the taxpayer supporting the friend. Now, onto the chart. Start here. Was Raymond a U.S. citizen? Yes, we've seen the Social Security card. So we go down to the next box, which is 4. Was the child the taxpayer's son, daughter, etc.? The answer is yes. Raymond is Sophia's son. Was the child under the age of 19? No. Raymond's 20 as of December 31st, 2021. Was the child under age 24 and a full-time student during some part of each of the 5 months of the year? That's a definition of a full-time student. Full-time actually means you're taking more than half of a normal load, but the point is you have to do that for 5 months. If Raymond had started college in September, October, November, December, that would not qualify him as a full-time student for the year. But we know he was at college for 9 months, so the answer is yes. We're down to box 10. Is Raymond younger than Sophia? Yes. We go to box 13. Except for temporary absences, remember that's at school. Did Raymond live with Sophia for more than half of the year? Yes. So we have gotten down to, we're going to move to page 2, box 16, which is the top box on the second page. Was Raymond the qualifying child for any other taxpayer? And the answer is no, because the ex-spouse has agreed not to claim Raymond or try to claim Raymond from 2021. So we follow the no down to here. Is the child filing a married filing jointly return? Which is basically to say, is Raymond married? And the answer is no, he's not. Can the taxpayer be claimed as a dependent on any other taxpayer's return? So is Sophia herself a dependent because someone else provides, say, more than half her support? And the answer is no, she's independent. So we go down to 29. Were the parents divorced, legally separated, lived apart all the last half of the year? And the answer is yes. Are they filing separate returns? And the answer is yes. Was the child, Raymond, in custody of one or both of the child for more than half the year? Yes. Sophia had custody of Raymond for more than half the year. Did one or both of the parents provide more than half the support? Yes. Does the non-custodial parent have the right to claim the child's exemption per Form 8332 or a pre-2009 divorce decree? And the answer is he doesn't have an 8332, so the answer is no. Did Raymond provide more than half his support? This is box 34. No. So Raymond is the qualifying child and dependent for head of household. For earned income credit, for medical expense deductions, for child tax credit, although he's not under the age of 18 in 2021, and he is not eligible for child independent care credit because he's not under the age of 13. But the point is, he does provide the qualifying child for head of household, so Sophia has that filing status rather than filing as single as she did in tax year 2020. As mentioned before, there are two things you want to do after you finish the basic information section in TaxSlayer, but before you start looking at the tax documents for input. Those two are the special charitable contributions deduction and the RRC credit, the economic stimulus payments credit. So let's take a look at charity. The third paragraph in the interview notes for the court case mentions 2 donations of checks or credit cards, presumably, although it's certainly worth asking, but let's assume that those were, in fact, checks or credit cards, and $35 of stuff. So the $35 of stuff does not count toward the charitable contribution deduction. The amount that goes on to the tax return is $100. In the fourth paragraph, you'll note that Sophia got $1,400 for the third stimulus payment, although she is entitled, as it turns out, to that payment for both herself and her son Raymond. She didn't get the payment for Raymond, presumably because her ex-husband filed before the third stimulus payment went out, filed a 2020 tax return before that, and got that $1,400. So this is interesting because the $1,400 for Raymond presumably has been paid out, but not to Sophia. So there's sort of double dipping, but think of it basically as the IRS is not going to try to recoup a payment to Sophia's ex-husband that you can say in some sense he wasn't entitled to, but that's the way the rules are written, that there is no recoupment of EIP that has been overpaid. So on her husband's return, maybe he says, I got $2,800, but I only was entitled to $1,400, and there's no impact on the tax return for that. We'll take a look at TaxSlayer entries in a moment. Let's talk about where the other information on the interview notes would have come from, why you would have asked this information. So Sophia's divorce situation would have come from the first page of the intake booklet. But you might also have noticed that in the 2020 tax return, her filing status was single. So yes, you would ask her about alimony, and you would ask her about how she and her ex were handling Raymond as a dependent. And this may seem intrusive, but that's part of getting to an accurate tax return. And taxpayers generally don't have any problems with you asking that as long as you make it clear that you're doing it for the tax return and not just because you're curious. And you would ask about Raymond, why she only showed him as living as with her for 3 months. That impacts what you put into TaxSlayer. That's the first paragraph of the interview notes. And then the fifth paragraph, you want to gather information about educational expenses, because when you have somebody in college, there's almost always an education credit, either American Opportunity Credit or Lifetime Learning Credit involved. So you need to know what the expenses are. And you would have asked about health insurance because California has a health mandate and there are potentially penalties for not having health insurance for part or all of the year. For the W-2, there's nothing unusual except box 12A, E, $4,000. What is code E? Pub 4012 on page D-6 has information about codes in box 12, but the duck book is more useful. So code E is one of 6 different codes involving the taxpayer putting money into some sort of investment account that makes them eligible for the retirement savings contribution credit. So here's another reminder about that credit possibility. So if you went to deductions and credits, then education credit 1098-T, which is the form that would trigger you to look for an education credit, you'll arrive at the Form 8863 page. So there are some issues with this form as implemented in TaxSlayer. First, tuition and fees deduction is not available in tax year 2021, so that shouldn't be there. Second, the question about receiving a 1098-T with box 2 filled in is irrelevant because the 2020 version of Form 1098-T does not allow box 2 to have any entry, so that's going to always be no. So students are limited to 4 years of the American Opportunity Credit, and you will occasionally run into somebody who is in the, say, the first semester of junior college, or just took 1 semester of a junior college and didn't spend very much. And if they expect to go on to a 4-year college, particularly if they may take more than 4 years to graduate, then it may be better to take the lifetime learning credit and save the AOC opportunity for another year. The box on the 1098-T, there's a box that says whether the student was enrolled at least half-time. That needs to be marked as yes. Here's the question, basically, whether the students finished their equivalent of a bachelor's degree. They don't have to actually have a degree, but if they've done 4 years of post-secondary education before 2021 starts, then they're not eligible for the AOC. You need to theoretically ask about felony possession of controlled substances. And finally, this is a badly worded question and basically says if you're a young taxpayer and one of your parents is alive and you're not married, you're not eligible yourself to claim the AOC. But in this case, the student is Raymond and the taxpayer claiming the credit is Sophia. So the answer is Sophia is eligible for this. The Retirement Savings Credit form, which is Form 880, is available on the credits menu. It's the 5th entry. We are asked to enter any qualifying retirement distributions in 2020 or 2019. That's because distributions from retirement accounts in the past 3 years are subtracted from savings that are made in order to determine whether there's any credit possible. So Sophia, and you should ask, presumably doesn't have any distributions in 2020 or 2019. And of course, we know there are no retirement distributions, retirement income in 2021. So TaxSlayer knows about the traditional IRA contributions that were already entered, $500, so they don't go, again, do not get reported here. So we click on continue when you're done, and because you have the option of printing this particular form. This is one of 10 or so that you can do that. So let's click on that. That generates a PDF of the form. And we can take a look and see there's a bunch of, here's your $500. IRA, here's $4,000. That was done through the W-2 payroll wages. And some calculations. Basically, she gets credit for a maximum of $2,000 of donations, and she can gets 10% as a credit. So that's $200, and that is a non-refundable credit, which means It reduces taxes, but if she doesn't owe any taxes, then she's not going to get that $200. This completes the review of the court case. Please pause the video and turn to the expanded case, tasks 5 through 8. Now it's time to review the expanded case. The 1099 miscellaneous form is interesting because depending on where the income occurs, it flows to different places. In this particular case, the box 3 on the paper form is $750, and that's other income. This is an award, and getting awards is something that Sophia does not do with, quote, continuity and regularity, unquote. That's a criteria for income that should go on a Schedule C, self-employment, business. So this is characterized correctly. If it's mischaracterized, then you should look at the duck book on how to handle it. So again, there's not much here that's interesting. That $750 is going to flow to Schedule 1, line 8. So let's take a look at where it actually ends up, because Schedule 1 now has a lot of sublines on it. So if we go to the summary print page and we go to, you can poke around, there's a lot of subpages here. Let's go to page 3, which is where Schedule 1, income and adjustments, and on line 8, other income, we'll notice that this is pretty much munged. This is not uncommon in TaxSlayer, unfortunately. And if you complain to the TaxSlayer about it, they'll say, oh, that's a display issue, and we'll get to it. So rather than complaining about this, the solution is to go to the summary print page again and click on View and Print Return. And then it says generating a PDF, which isn't true. It's generating a page that will allow you to get to a PDF. When you click on Print Your 2021 Tax Return, you will get a PDF, a long PDF, with a lot of pages you do not want to give to the taxpayer. So do not use this when you're actually in real life. There's other ways to print the tax return for the taxpayer's copy. If you do click on this and get it, let me show you the critical page. Here we go. So on line 8, cancellation of debt, we've talked about that before. That's $32.50. And down here in Z is the Southern California Teachers Insurance Award of $750. Now you could argue it belongs in line I, activity not engaged in for profit income, but it doesn't matter. It'll end up in the right place. It'll flow from here, line 9, actually line 10, into the 1040, line 8. Sophia doesn't understand why the bank sent her this tax statement. This is a write-off of a credit card by the bank. Sophia says she's never been declared insolvent, which presumably means she's never declared bankruptcy. But insolvency and bankruptcy and the write-off by a creditor of a debt are two entirely different things. So the American bank presumably has gotten tired of trying to collect this debt from Sophia and has concluded that there's no point in selling this thing to a debt collector. So they are writing this off, and that is income to Sophia. That's why she got this 1099-C, and it's why the IRS expects this to be showing up as income on her tax return. Or to be more exact, the IRS expects this either to be declared as income or some additional paperwork filed with the tax return saying why it is not income. Payers who are insolvent can file paperwork to avoid having this declared as income. Unfortunately for Sophia, that is out of scope for the Tax-Aide program. So Sophia has two choices. She can accept that this is going to be income and include it as income on her tax return, or she can go to a paid preparer or hopefully be able to use tax software to file her return. Sophia's income, not including this, puts her at the 12% marginal tax bracket, and you can tell that by comparing her taxable income to her tax. Her tax is more than 10%, which means she's moved into the 12% tax bracket. So this $3,250 of additional income is going to cost her around $390 in additional taxes. That's in the federal, and it may increase her state tax as well. That's not going to make Sophia happy, but it's almost certain that she can't find a paid tax preparer who will charge less than $390 to do this extra paperwork. And also, she may not be insolvent. Her assets may exceed her liabilities, in which case she absolutely doesn't have a choice. She has to file and declare this as income, and she might as well do it with us because we'll do it for free. If the amount being written off were really large, this would kind of put the taxpayer in a dilemma because, on the one hand, a lot of extra taxes is owed, but assuming that the taxpayer truly is insolvent, it could be very difficult for them to find a tax preparer, paid tax preparer, who will do that for them unless there's a refund coming that's large enough to cover the fees for the tax preparer. Unfortunately, there's nothing we can do in that situation other than present the taxpayer with the two options and let them make a decision. One final note. Although for the Tax-Slayer program as a whole, write-offs of debt that involve a main home are in scope. In California, for the California Tax-Aide program, the only cancellation of debt that is in scope is non-business credit card write-offs, which is what this is. That's the reason for main home write-offs, main home cancellation of debt not being in scope, is that on the state return, California treats that write-off differently, and that unduly complicates the return. Fortunately, at least as far as it goes for tax preparation purposes, we're very unlikely to see people getting write-offs, cancellation of debt on main homes because housing prices have soared, and so pretty much nobody's underwater at this point. So the last thing to enter into Tax-Slayer is that 1099-C, cancellation of debt. Presumably you found how to do that under income. On the income menu, you go to less common income, and there's cancellation of debt. Click on edit. And here's cancellation of debt. If you really had to go somewhere else, you would click other income not reported. You go to cancellation of debt, and there is another step to take, and we'll ignore that. And here you put in the information from the 1099-C, and as we saw, that information flows to the right line on the right subline on Schedule 1, line 8. That's new this year. Previously, there was a single line for that schedule. So you're done. Question 1. What if Raymond worked in 2021 during summer and in the school year and earned somewhere around $14,000? Can he still be claimed by his mother in 2021 as a dependent? Well, let's take a look at the qualifying relative tool and see what it says. We start again in box 1. Raymond is a U.S. citizen. He's the son, so that's a yes. He is not under 19. He is under age 24 and a full-time student. He's younger than Sophia. He lived with her for more than half of the year, so we're on to page 2, box 16. Not the qualifying child of anybody else because the ex-spouse isn't claiming him. So we're going to go down to no. Child isn't married. Sophia can't be claimed as and by anybody else. Parents are divorced, legally separated. Yes. Filing separate returns. Custody of both parents during the more than half of the year. Yes. Half the support. Yes. Does the custodian have the right to claim the child's? No. Did the child provide more than half his support? So there's actually a lot riding on the answer to this question. If Raymond did not provide more than half his support, all sorts of good things happen on Sophia's tax return. If he did provide more than half his support, the only thing that he's of value for Sophia is earned income credit. Kenny doesn't even qualify for the $500 other dependent credit. So, before we answer the question about the half part, let's talk about support part. So support means not only things like food and clothing, it also means lodging. And because Sophia had provided a home for Raymond for 12 months, even though he wasn't present, that's a very significant amount of support. In addition, the fact that Raymond earned $14,000 doesn't mean he spent $14,000 on his own support. He could very well have put $5,000 of that into savings. So there is a support sheet in Pub 4012, but by and large, unless Raymond had made a lot more than $14,000, it's very unlikely that he provided more than half his own support, and so the answer is going to be no. Question number 2. What if Raymond was not in school during 2021? Instead, he worked part-time, lived with his mother, who provided him more than half of his support during the tax year. What impact would this have on his mother's tax return? Well, first, of course, there would be no education credit because he wasn't in school. As far as other impacts, let's turn again to the QR tool and see what it says. All right, let's try chart 1 again. So Raymond is a U.S. citizen, yes. Is a son, yes. He was not under 19. And here's where we go different. Raymond was under the age of 24, yes, but he was not a full-time student. So we go to no, and we are going to chart 2 because Raymond is not a qualifying child. So Raymond was not the qualifying child. We already know that. Was not the qualifying child of any other taxpayer. Raymond is a child. Sophia did provide more than half the support. The gross income is less. The question is Raymond's gross income less than the threshold amount? What's the threshold amount? $4,300. So the question didn't actually say whether Raymond made more or less than $4,300. So we've come to a fork in the road. Raymond might have made more than $4,300 or might have made less. The problem doesn't say. The question doesn't say. So let's assume for the moment that Raymond made more than $4,300. So we're going to go down no. Was Raymond totally and permanently disabled? No. So here's our bottom line. Raymond is the qualifying person for qualifying widower, but that doesn't apply in this case. Sophia's spouse did not die. For the child independent care credit, which is also not relevant because there's no child care, and medical expense deduction. So to the extent that Sophia paid Raymond's medical expenses, she could claim that as part of her itemized deductions. So that's kind of disappointing, but it makes the point that if a taxpayer has an older child living in their house, it doesn't take a whole lot of earnings before that child is essentially of no tax benefit. So let's assume that Raymond made less than $4,300. That has more possibilities tax-wise, and obviously you follow the facts, not what you'd like the facts to be, but let's assume the fact is he made less than $4,300. We go down here. Can Sophia be claimed as a dependent on any other tax return? No. Did Sophia file married filing jointly? No. We're going to go to box 5, page 5, box 22. So here's box 22. Except for temporary absences, did Raymond live with Sophia more than half the year? Yes. So Raymond is the qualifying relative and dependent for head of household. Well, that's good. For credit for other dependents, that's worth $500. For education credit, for medical expense deduction if Sophia itemizes, and for child independent care credit if Raymond were young enough or disabled, which he is not. So not too bad. You've lost the child tax credit because Raymond's not a student, but pretty much everything else, earned income credit isn't here also. But at least you've got head of household, which is a much better filing status than single. And finally, what if Sophia's former husband had contributed money to help pay Raymond's education costs? For example, had made payments directly to the university for some of those costs not covered by the scholarship. Does this affect the amount that Sophia can claim for Raymond's education credit? And oddly enough, the answer is no, it does not. Payments made by others for education of a dependent are deemed to be made by the parent, the taxpayer, and are treated just as if the taxpayer had made the payments themselves. So this presumably was a rule, the law that was made in order to encourage, for example, grandparents to contribute to the education of a grandchild, or an uncle or an aunt for that matter. But it doesn't matter what the relationship of the person making the payments is to the taxpayer. These payments are deemed to be made by the taxpayer. So, no difference. This concludes case number 4, Del Mar. You're now ready for case number 5.